Okay, so that wraps it up for our panel sessions for today, but we do have one final session where we've asked Larry Tabb to join us from the US to give us his thoughts and insights on what we actually see or what he's noted from today. Do we have Larry with us? Is Larry on the line?
Here. I can't see anybody, but I'm here.
Oh, you can hear me? Yeah. Right, so Larry, for those of you who don't know, I actually, a decade ago almost, started working for Larry Tabb in New York. That's a long time ago, isn't it, Larry?
God, it's a long time.
And we used to sit and have chats about those crazy folks in Europe, as he liked to describe it, So what do you make, Larry?
I still don't understand the European regulatory process, but that's a different story.
You still don't understand it, even after me trying to explain it for 10 years. I'm clearly not doing very well.
It's all right. It's great.
Europe is really kind of where a lot of some of the market structure or regulatory process is really being developed. It's become really a petri dish for new and interesting ideas. Some of them are working, and some of them maybe a little bit more challenging. But I think it's it's certainly absolutely kind of pushing the envelope in terms of trying to migrate from kind of a very messy kind of competitive framework to a to one where the government or the regulators in the industry are working together to try to create kind of the perfect framework, if there even is such a thing.
No, you're right. I think one of the things that we've, just in terms of what we've been looking at over the discussions that we've had today, clearly the industry's had a lot to contend with in relation to COVID-19. But one of the things that I think has come out just from the buy-side panel and also the sell-side panel that we had was just how well the market held up in terms of technology. And again, this is what we saw in Europe. Is that what you saw in the US as well?
Conversely to that, Larry, as well. Conversely to that, one the other conversation we had is the fact on the US Treasury market, and where liquidity kind of dried up, and we had it from the regulators and also buy-side traders. There was an issue. So, is there a converse opinion here in terms of US isn't quite working quite right?
The crisis actually functioned pretty well. We had, certainly. In terms of share volume, very close to record volumes, but in terms of nominal traded or value traded, we saw almost twice as much value turned over during the crisis with virtually minimal impact in terms of infrastructure. We're in the process of also going out to buy-side firms and talking with them about how they fared during the COVID. And I'm impressed that virtually all the buy-side firms that I've talked with have been able to, migrate their operations to a work from home environment in a virtual trading environment. And we've had, some communications issues in terms of face-to-face, being able to see what other people are thinking or doing. But by and large, their technology infrastructure worked pretty seamlessly, which is really very impressive.
Which is one of the positives that we think has come out from this whole experience. But in going back to an earlier panel that we had, I think one of the challenges for the industry now is, yes, the technology held up. That was great. We've all got a massive tick in the box. I think that what it is now is how do we take the positives and keep those positives, but actually start fixing some of the interesting challenges that you've raised about, that interaction with people, which again goes back to the panel that Ali had earlier. That sort of collaboration, the face-to-face collaboration, and also how you move junior members of staff up through the ranks.
And a very important point there, Larry. I know you support mentorship massively. So how do we mentor people? How do we develop talent and get that growth?
That's really the biggest challenge. Now joining Bloomberg, It's a huge organization. The senior people generally are pretty comfortable working from home. The junior people, though, are kind of, I wouldn't say at a loss, but it's a much more challenging issue for them, with mentorship and how do I learn in this environment when I'm, only a couple of years into the industry. And I think that's a really interesting challenge. And some of the traders I talk with are having the same issue. The ones that seem to be in the office are the ones that have new people have onboarded new traders who don't know the process or don't know how their systems or technology or trading styles work. So on the other hand, hopefully one of these days we'll be through it. But I'm not sure I'm not sure that anyone really thinks that we're going to go back to everybody show up 9 to 5 Monday through Friday anymore, or more like.
And I think that was also something.
4:30 or whatever.
There was something interesting that came out just in terms of, a firm mentioning that they were going to move from New York to Nashville. Now, that in itself is quite a cultural change that we're going to see in the industry. So where do you think that leads?
The other thing actually that's really different in the U.S. that and it kind of broached in with some of the liquidity concerns is that the amount of flow that has migrated off exchange, really driven a lot, I think, by retail trading, has been massive. We're now at about 44% of order flow is being matched off exchange, and a very significant portion of that is being driven by only a limited, 2, 3, 4 major wholesalers. And while we don't have double volume caps or single volume caps or issues around that, we may see something like that, or we may see pushes. I would assume the exchanges are going to push to try to get more of that flow on exchange or more accessible. And the buy side doesn't even see it, because they can't access it.
They can't access the retail flow. I was going to say, so that brings us to a very critical element. So again, going back a few years, Larry, we discussed the financial transaction tax. What are your views now on where that's going? Is that another European idea that will end up in the US?
New Jersey actually wanted to implement a transaction tax, and for those that don't know, the majority of all equity trading happens in New Jersey, in a triangle between Mahwah, New Jersey at the north, which is where the New York is, Carteret in the south, where NASDAQ is, and Secaucus, where CBOE is, all in New Jersey. That said, yesterday, New Jersey governor said they're going to postpone looking at this as a local tax. That said, there's a lot of discussions around a national tax, which would be much harder to get around. I think as an industry participant, I think it would be very challenging for the industry. On the other hand, they're looking for tax revenue wherever they can find it. So I'm not. It's going to be harder to defeat it this time than it was a couple of years ago.
So are we converging to a more European form of regulation? You're talking about more granular approach. You're mentioning double volume caps. You're mentioning FTTs. Is that the direction of the US?
I wouldn't say that's the direction, but I think that there's going to be a lot more discussion of these topics, because the exchanges are going to be complaining about price discovery eroding because of the over-the-counter issue. The buy side, even though a lot of the names that are being traded in retail aren't the names that they're trying to grab liquidity in, but it's still a large portion of liquidity that they don't have access to. So I think that's going to be an increasing discussion. And the transaction tax is just going to be a factor that with all of the spending and the huge deficit, there's got to be a way to recoup some of that money, and besides just inflating it all away over 20 years or whatever it is.
So if we go back to that you're talking about that on venue and dragging more onto the US venues, that's you're obviously talking about the US point of view there. There's obviously a differing view to the industry in terms of the OTC volumes and the differing approaches of liquidity providers, and obviously just driving it all onto venue. That's not the end result, right?
Can you repeat that question? I'm not sure I got it.
So it's just saying that you've got to drive everything onto venue. That's not the right result for the end investor. You need to have the modularity.
No, I'm not. Yeah, I'm not sure that driving everything to the exchange is the right end goal for the investor. I think the overall question becomes is what do they want the U.S. market structure to look like? Is it going to be investor-oriented, and if that's the case, then segmentation is probably the right answer, because my order flow looks different than yours, looks different than a hedge fund, looks different than a big buy-side firm, and so, but that then moves you away from a centralized type market, or should the market be more centralized, which is where Europe, has pushed it with MiFID II, trying to refocus everything about transparent and accessible liquidity. And so the question then becomes a fundamental question.
I think there's a much more fundamental question here, which came out in the SEC's comments last night from Hester Peirce, where she described it as needing to defend principles-based regulation. Whereas the comments that we heard this morning, it was very much around, yes, that's good. And ASIC, they made a very strong case for the need to actually limit the amount of regulation that we do have and to actually curtail it back and to reduce some of the red tape, which again, Tilman Luder is a very strong proponent of. But we've got a challenge here in that if financial services needs where if they want to push financial services to where it needs to be to support a post-COVID recovery, the industry isn't moving fast enough. So what do we do about that as industry participants?
That might be a question out of my pay grade. What do we need to do as participants? I think what we can do as participants, I think, is continue to move along with just making the financial community more connected, more seamless, more electronic, more efficient. Now from a governmental standpoint, what should the markets be doing, and where should we be flowing? Where should capital be flowing, and how should it be allocated? That's a big question, because you've got the Fed coming out basically saying for the next 2 years you're going to have a zero interest rate policy. So if we're in a zero interest rate policy, it's going to be really inexpensive for private equity to borrow money and funds companies. So then the question is, what does the public markets do? What do the exchanges do?
At precisely the point they want more public ownership.
Yeah.
Right. Well, yeah. And then you get comments like what came out earlier this week, that the U.S. government wants to own a piece of TikTok if we nationalize it, which is like, what? So there are all sorts of comments depending upon whether we're talking about what's coming out of the executive versus the regulatory side versus the market versus the Fed, and it's really hard to align all of these into a comprehensive framework. Personally, I'm a little bit more hands off. On the other hand, I think that a centralized market actually is very good for price discovery, and it's good for investors. So if we wind up continuing to see the over-the-counter market pick up so much, I can't see how the exchanges don't make a huge fuss, and they may be right in doing that. Now that may just be a factor of the pricing issue, and I might get in, might focus, a bit more on let's reduce access fees. Let's make it more economic to put more of this flow on exchange. Maybe create mechanisms like periodic auctions to try to figure out how do we get some of these blocks onto exchange, even though I know some of the European regulators have been.
Well, I was going to say, so that's another factor that's coming over the water, periodic auctions moving across to the US with SIBO. So again, it's sort of, all of a sudden the direction of travel seems to be switching in the opposite direction. But what would you say what's the one thing that Europe should pay attention to coming out of the US in the next 12 months, other than the election, obviously?
Well, the election. What is the interesting thing? That's a good question. Clearly there's some interesting stuff going on with the market data side. The SEC has some proposals out for market data infrastructure and kind of its own view of where they want the consolidated tape to be. That said, I think Europe's already on top of that and trying to migrate that way. I have to say I was encouraged. I think actually Europe is actually leading some of this forethought on market structure, and the U.S. I think is looking, is taking a step back and trying to keep a hands off of growth.
Yeah. Okay. Right. But in terms of, so on that last point then, can I just get your views on ESG and just where you see that happening? Because that's obviously something that's being spearheaded out of Europe, but there are direct impacts from climate.
Given the fires that are going on in the whole West Coast, ESG, I think, becomes a much more important, discussion now than it was even a month ago or 2 months ago. The ESG is absolutely being driven out of Europe. I think there were a lot more confused about it here, especially given the direction of the current administration. I think if we wind up with the change of administration, I think there'll be a very significant change in ESG and certainly environmental and climate out of the new if Biden wins, out of the Biden administration. But I think I would agree with your discussions at the end of the last discussion is that we need to figure out a way how to price carbon. And clearly, the companies have been looking at carbon as a free ride. I can do whatever I want to the environment and it really doesn't impact me. So I can manufacture cheap. I don't have to price that in and let the world absorb that cost. I don't think that, especially if you look at what's going on in Oregon and California, I'm not sure we can afford to do that much more.
Yeah, so capital markets becoming a force for good. I believe you wrote about that an awful long time ago. Well,
I hope that happens.
Yeah, well, we can live in hope, Larry. We can live in hope. So thank you very much indeed for your time. I think what we need to do now is just wrap up the event today with our key homework. So we'll bear in mind the comments that you made, Larry, about the need for greater collaboration, and that hopefully we can continue the debate going forward, Europe to US. But Matt, can I ask you, what's the one thing in terms of the panel discussions that you've had, just on the takeaway that you want to make in relation to how FIX can actually help deliver on some of the challenges that we talked about today?
I think there's a lot out there, Rebecca. I honestly think there's a lot. But when we look at this, I would take a step back and actually go, how can we as an industry engage and what do we want out of the regulators? Because all too quietly, we never ask the questions to the regulators. And I think one of the things that came out today was from Greg from ASIC, where he turned around and he said, they are going to be doing the review on the data fields they're looking at internationally and the fields where they've got duplications and where we're seeing over-implementation and over amount of red tape being produced. So I think from a FIX perspective, we need to be taking that with both hands, working with the regulators and trying to identify the red tape, cut it down, cut the costs of what we're trying to put together and deliver a more effective market. We deliver a more effective market, we deliver better data. We deliver better data, it's going to have a positive outcome for all these challenges we've got. What about yourself?
Well, obviously, I think one of the key things that I found was actually the positivity. So the positivity in terms of the way the market responded to COVID-19. People anticipated it being a disaster. It wasn't. The technology held up. We're in a very different state of affairs than we were back in the global financial crisis of 2008. So that's a positive. I think also it's just the willingness for people to learn the lessons. So we're in a very different environment now in terms of people actually looking to collaborate. So if you roll it back to 2008, there are no more wolves on Wall Street. This is now, greed is no longer good. It's actually more important about the industry working together, because it's through that collaboration that we actually get the end results. And it is, as you say, it's about lowering the cost of the industry, increased standardization. That's not to say that people can't have that level of diversity, both in terms of what they invest, how they invest, the products that they sell. But actually, the more that we can actually collaborate on that standardization of data and how that information passes from front office to back office, the better off we're all going to be in the industry.
I think another point there, which came out as well from that panel when we were looking at Ali's panel, was the mentorship, the mentees, and making sure that we can, in this current environment, which is difficult, how can we make sure we foster talent? How do we bring that together?
Yeah.
And I think, again, we've got another initiative there in Fix, where we have mentors, senior mentors within the industry, looking to sort of seek mentees to help them through and going through this virtual world. And so, if people are interested in that, they should get involved, right?
Yeah. And actually, going back to Simon Stewart's comment on Ali's panel, where he was talking about the fact that actually in a virtual world, people feel more comfortable in speaking up. So maybe we can get different individuals at the table and get greater involvement from the level of people. So again, what I'm going to say now. It all comes back to people like you who are watching. Thank you so much for participating in our first Fix EMEA virtual event. But it would not be possible without you and our sponsors, and we're extremely grateful for you taking the time.
Yeah, I think the critical thing, that you're completely right there, and it's all about getting engaged and getting involved. I think today, let's face it, we've seen a record-breaking day today. I think we've had 1,600 registrants. We had over 1,000 people on one panel looking in. We've done something completely different.
Not without its teething issues, it has to be said.
Not without its teething issues.
But in the early days of electronic trading, I can remember trying to trade Nokia completely in the dark as every single system went down. So there's definitely things that we can learn and improve on from today. But it has been, as you say, a record-breaking day. And hopefully the first of many future events that we will be able to put on virtually, COVID or no COVID.
I think there's one thing we have to do, Rebecca, because we've been in front of the camera all day, but actually there's a ton of people behind the camera who have worked tirelessly on this.
Yeah.
And we've got Maria, Naomi, Kelly, Amy and Nina in the programme office. We are a really tightly run organisation, and these guys have
knocked it out of the park and
done an amazing job. So I think there is a massive virtual thanks and a virtual clap for those guys, because it's just
we normally have you up on stage to say thank you, but unfortunately we can't do that today. But we would, yes, very much like to say thank you, and once again thank you to you at home or in your office participating in the Fix EMEA Virtual 2020. Thank you.
Thank you.